The role of emotions in investment decisions. Avoiding common pitfalls. Hey everyone, welcome back to my channel. Investing can be a roller coaster ride filled with highs and lows, gains and losses. While financial markets operate on data, trends, and analysis, the human element of emotions plays a significant role in investment decisions. Emotions such as fear, greed, and overconfidence can cloud judgment and lead investors astray, often resulting in costly mistakes. Understanding the role of emotions in investment decisions and learning to manage them effectively is crucial for achieving long-term financial success. In this video, we will delve into the influence of emotions on investment choices and discuss strategies to avoid common pitfalls. The psychology of investing. Before diving into the specific emotions that impact investment decisions, it's essential to understand the underlying psychology of investing. Human beings are not always rational actors, especially when it comes to money. Behavioral finance, a field that combines psychology and economics, sheds light on the various biases and heuristics that affect decision-making in financial markets. One of the fundamental concepts in behavioral finance is prospect theory, which suggests that individuals tend to weigh potential losses more heavily than equivalent gains. This asymmetry in decision-making can lead to risk aversion, where investors are more inclined to avoid losses rather than pursue gains, even if the potential for profit outweighs the risk. Another crucial aspect of investor psychology is herd behavior, where individuals follow the actions of the crowd rather than making independent judgments. This herd mentality can lead to market bubbles and crashes as investors buy or sell assets, based on the fear of missing out, FOMO, or the fear of losing everything. Emotions and investment decisions. Now let's explore some of the common emotions that influence investment decisions and the pitfalls associated with each. 1. Fear. Fear is perhaps the most potent emotion in investing. During times of market volatility or economic uncertainty, fear can drive investors to panic sell their assets, fearing further losses. This knee-jerk reaction often leads to selling low and missing out on potential rebounds in the market. Overcoming fear requires discipline and a long-term perspective. It's essential to focus on the underlying fundamentals of investments, rather than reacting impulsively to short-term fluctuations. 2. Greed. On the other end of the spectrum is greed, which can tempt investors to take excessive risks in pursuit of high returns. Greed can manifest in various forms, such as chasing hot stocks, investing in speculative assets, or leveraging investments beyond one's means. While taking calculated risks is an integral part of investing, succumbing to greed can lead to catastrophic losses. Maintaining a balanced portfolio and adhering to a well-defined investment strategy can help mitigate the effects of greed. 3. Overconfidence. Overconfidence bias occurs when investors overestimate their abilities and underestimate the risks involved in investment decisions. This can lead to excessive trading, overconcentration in a single asset or sector, and failure to diversify effectively. Overconfident investors may ignore warning signs or dismiss contrary opinions, believing they possess superior knowledge or insight. To counter overconfidence, it's essential to remain humble, seek diverse perspectives, and continuously evaluate and adjust investment strategies based on new information. 4. Regret. Regret aversion is the tendency to avoid making decisions that could result in regret, even if they are objectively the best course of action. Investors may hold on to losing investments out of fear of admitting failure or missing out on a potential turnaround. Similarly, they may avoid selling winning investments prematurely, fearing that they could have made even more profit. Overcoming regret aversion requires accepting that losses are an inevitable part of investing and focusing on making rational, forward-looking decisions rather than dwelling on past mistakes. 5. Confirmation. Bias. Confirmation bias occurs when investors seek out information that confirms their existing beliefs or opinions while ignoring evidence to the contrary. This can lead to a distorted view of the market and poor investment decisions based on incomplete or biased information. To mitigate confirmation bias, investors should actively seek out diverse viewpoints, conduct thorough research, and remain open to changing their minds in light of new evidence. Strategies to manage emotions. While emotions will always play a role in investment decisions, there are several strategies investors can employ to manage them effectively. 1. Develop a plan. Having a well-defined investment plan can provide a roadmap for decision-making and help investors stay focused during periods of market turbulence. A comprehensive plan should outline investment goals, risk tolerance, asset allocation, and criteria for buying and selling investments. 2. Diversify your portfolio. Diversification is one of the most effective ways to manage risk and reduce the impact of emotional decision-making. By spreading investments across different asset classes, sectors, and geographic regions, Investors can mitigate the impact of individual stock or sector volatility on their overall portfolio. 3. Stick to your strategy. Once an investment plan is in place, it's crucial to stick to it, even when emotions are running high. Avoid making impulsive decisions based on short-term market movements or the latest investment fads. Instead, focus on the long-term fundamentals of your investments and resist the urge to deviate from your strategy. 4. Practice self-awareness. Self-awareness is key to recognizing when emotions are influencing investment decisions. Take the time to reflect on your feelings and motivations before making important investment choices. If you find yourself acting out of fear, greed, or overconfidence, take a step back and reassess your strategy. 5. Seek professional advice. Working with a financial advisor can provide valuable guidance and perspective, especially during times of uncertainty. An experienced advisor can help you navigate market volatility, avoid common pitfalls, and stay disciplined in your investment approach. Emotions are an inherent part of human nature, and they will always play a role in investment decisions. However, by understanding the psychological biases that influence our behavior and implementing strategies to manage them effectively, investors can avoid common pitfalls and achieve their long-term financial goals. Remember, successful investing requires discipline, patience, and a commitment to staying true to your investment plan, even when emotions are running high. By maintaining a balanced perspective and focusing on the fundamentals, investors can navigate the ups and downs of the market with confidence and resilience. Please like and subscribe to my channel and click the bell icon to get new video updates.